An asset is something that you buy for the sole purpose of making money. A liability is something that you buy, which is something that loses you money. Your clothes are liabilities. Your vacations are liabilities. Eating out is a liability. All that stuff that makes you look rich are liabilities, but assets are things that you buy for the sole purposes of making money. This could be a real estate investment, not the home that you live in, but a real estate property that you're buying for the sole purposes of generating cash flow. This could be your stock market investments. This could be a business investment. This could be a startup that you're investing in. All these things are assets that you're buying or investing in for the purposes of making money. Well, when you go through a recession, you see two things happen. First, the bad assets become more apparent and they come out and they get hurt, and many times they will go bust. They will go bankrupt. They will go under. Something bad will happen to these bad assets. Second, the bad assets hurt the price of good assets because now people get scared. They start panic selling. They get away. People sell out of fear, which causes the price of good assets to go down because not everybody's selling. This creates opportunity for you to come in and buy these good assets at a discounted price. These are called distressed assets. Distressed assets are companies, their businesses, their real estate, things that get hurt because of everything else around it, or these are assets that get hurt because the economy is hurting this asset, and you can come in and buy this asset, and if this asset can turn around, you have the opportunity to see huge returns on your money. Let me go over a few examples. When the 2000 dot-com bust happened, you saw the entire internet market get hurt because you had a number of bad companies, things like pets.com, things like boo.com, that went bust, that made the entire digital technology industry get hurt on the stock market. You had a lot of bad companies. Many of them went to zero. All their investors lost everything. But then you also had the good investments that got hurt very bad because of the bad investments that got hurt. These are companies like Amazon, companies like Microsoft, companies like Apple. When the 2000 bust happened, the Apple stock fell by over 70% in just 1 year. The Microsoft stock fell by 63% in 1 year, and Amazon fell by 92% in just 1 year. Let's fast forward to the 2008 crash. The stock market in general got cut in half. More than 50% of its value was gone in the 2008 crash, and real estate was decimated. The real estate market fell by upwards of 90% in some neighborhoods. I'm from Michigan, and our economy got hit especially hard when the real estate market got hit. And you saw some neighborhoods in my area where home prices fell by more than 92% over the course of the 2008 crash until 2012. Now let's fast forward to the 2020 crash. Stocks again were hit very hard. You saw the stock market fall by upwards of 40% in just a few weeks, and the more speculative assets, in this case cryptocurrency, fell by 50% in just 1 month. We have seen the same things play out in each and every market crash and economic downturn and recession for centuries now, where things go wrong, people panic, they sell, and this creates opportunity for new investors to come in and buy these distressed assets at a discounted price. Now, of course, in order to be able to purchase these distressed assets, you have to have access to cash, but the second thing is you have to have access to the right education. How do you find the right investment? Now, of course, looking back, if you saw Amazon stock fell by 95%, you might say that's a no-brainer, go in and buy it. But imagine that for a moment, where you see this no-name company that's fallen by 90%. Do you come in and buy, or do you run away? It can be very scary. And this is where you have to understand how involved do you want to be with your investments, because not everybody is meant to be listening to earnings calls. Not everybody is meant to be picking companies. Not everybody is meant to be investing in real estate. Not everybody should be buying cryptocurrency. Not everybody should be starting a company. Not everybody should be investing in startups. You have to figure out where it is that you want to be and how involved that you want to be. And once you figure that out, you want to start educating yourself on that topic. That way you can make better decisions with your money. Here's the reality. For 90% of people, you probably shouldn't be investing in individual companies. You probably shouldn't be going out and investing in real estate unless you are willing to put in the time and effort to do that. If you are willing, you are mentally capable of putting in the work and dealing with the psychology with it. Now, if you do want to invest in these companies, now you want to be going out and learning how to research companies. How do you listen to an earnings call? How do you read the cash flow statement? How do you read the balance sheet? How do you analyze the numbers? How do you figure out what's undervalued, what's overvalued? And then when you find that out, now you're looking for the right companies, and now you can make more risky decisions, because it is riskier for you to invest in a company on the way down than investing in a fund that gives you exposure to a lot of companies. So if you want to do that, fine. Just understand you're taking on more risk. But if you're willing to do that, start investing in your own education to be able to do that. Now, for regular people who don't care about being investors, who don't want to be a full-time investor, who don't want to devote hours of their life researching how to invest their money, the next best thing is to figure out what it is that you want to invest in and how to get exposure to that with as little time investment as possible. For example, in the stock market, you don't have to go out and invest in companies. You can invest in ETFs or index funds that give you exposure to a lot of different companies in a niche. Now, what you can do is you can find a niche that you feel gets hit especially hard. Maybe it's tech, maybe it's healthcare, maybe whatever that you feel like will see a lot of upside in the future that everybody is doubting. Now, you can come in and invest in this niche when it's down, and then you can keep investing, and then if things go up, well, now you get to reap the rewards of that. Now, of course, you got to understand investing has risks. I'm not telling you what to invest in, but investing has risks. You are never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. If you have specific investment questions, talk to a licensed financial advisor. But the whole idea here is you find good assets that are hurt by bad assets, and then you want to be able to come in and buy these good assets at a discounted price. If you're not willing to invest in the individual assets, if you're not willing to put in the work to find what is that good asset, then invest in a broader base of assets in that niche, or you can even just invest in the broader stock market, invest in the S&P 500, invest in the general stock market. That's even broader. Again, the level of research that you do is going to depend on how involved you want to be. And if you want to just invest in the stock market, well, now you create a system where every week, every 2 weeks, every month, you are just investing your money into the market and you let the market do its thing, because history has showed us that time in the market beats timing the market many times over. And if you don't want to put in that work, just create a system where now every week, every 2 weeks, every month, your money is automatically invested into the market. And then the only thing you change is when things go wrong, when the market goes down, when the economy gets hit and the market hurts, that's when you come in and just buy more. You just increase how much money you're investing. That's the only thing you change. You don't sell, you don't turn it off when things go wrong. You want to keep buying, because those are the times where you can buy even more shares of the companies for the same amount of dollars that you're putting in. Now, if you are an investor and you're looking for an easy way to stay up to date on what's happening in the markets, that way you can make better decisions with your money, then you can join Market Briefs. It's a completely free tool that I created. It's a completely free newsletter where every day my team is breaking down what's happening in things like the stock market, the real estate market, crypto, the global economy, and our own economy. That way you can make better decisions with your money. Not only is it free, but it's brief, and you will understand what's happening in the markets, and you're actually going to look forward to reading Market Briefs every morning. I know this because we get emails every day from people talking about how much they love Market Briefs and how much value they get from Market Briefs for free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs for free down in the description below. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.